Chapter 19 is Peter Lynch's plain language warning about three risky corners of the market: options, futures, and short selling. His message is simple. These are not toys for most individual investors. They are gambling devices wrapped in financial jargon, and they move money from the many to the few. He starts with options and futures. In commodities, these contracts can serve a useful purpose. A farmer, for example, can lock in a price for wheat at harvest, but when people try to apply the same tools to stocks, they usually lose. Lynch says the odds against an amateur in these markets are terrible. He stresses two structural problems with options. First, they are time-limited instruments. They expire. If the event you expect happens too late, the option is worthless. Second, options are expensive if you want continuous protection. You must keep buying more options, and those premiums add up. When people use options as a form of portfolio insurance, they can waste 5 to 10% of their capital every year on premiums. Lynch's view is echoed by the likes of Warren Buffett. These derivative markets are best handled by professionals, or not used at all by most individual investors. Next, Lynch turns to short selling, selling borrowed shares in the hope of buying them back later at a lower price. On paper, shorting looks elegant. Borrow a stock at a high price, sell it, wait for it to fall, buy it back and pocket the difference. In practice, it is a high-risk activity with unlimited downside. A normal stock can only fall to zero. A shorted stock can theoretically rise without limit. If you are short and the market moves against you, you must post more collateral or be forced to close the position at a loss. Lynch tells the story of an intelligent investor who shorted Resorts International and watched it move from less than $1 to $70. A humbling disaster. Even when short sellers are eventually proven right, they often pay a terrible price in the meantime. Lynch also points out the practical burdens of shorting. You must pay dividends and other benefits to the lender of the shares. You cannot freely spend the proceeds of the initial sale, and brokers can call back the borrowed shares. All of this makes shorting a business that requires not only conviction, but serious resources and nerves of steel. Throughout the chapter, Lynch emphasizes the human side of the problem.